I encourage you to look at the file that I put together on the historical behavior of asset returns. And really, I think it's a good starting point for the analysis of risk and return, which is the foundation of finance. So if you look at the historical behavior of asset returns, it's useful to group assets into a number of different classes. And this is what I try to do in this historical overview. So I look at the least risky asset, which is a U.S. Treasury bill, to the most risky asset, which would be a portfolio of stocks that are from fairly small capitalization firms, or so-called small firms. Now, there's a number of classes in between, and if we kind of go from low risk to high risk, we could go from Treasury bills, which are fully guaranteed by the U.S. government, to U.S. Treasury bonds, which are longer term, but they are guaranteed by the U.S. government. There's more risk in terms of what might happen in terms of inflation, which could severely degrade the value of these bonds. Whereas with a Treasury bill, they're usually 90 days to maturity, and not much can happen in terms of the price of these instruments. The next asset class would be corporate bonds, which are what we usually examine are high grade or AAA rated bonds. These are fairly low risk in terms of the probability of default, but they're definitely riskier than government bonds in that the corporation could default, could go into bankruptcy, and you could lose your money in terms of these bonds. The next risk class are U.S. equities, and usually what we look at is a broad portfolio of U.S. equities. A popular portfolio is the Standard & Poor's 500 index, and this is a portfolio of 500 securities that are traded on major exchanges in the United States, and these stocks are so-called value weighted, so that we weight the company by the number of shares that has outstanding multiplied by the market price of each share. So obviously some companies have a greater weight than other companies. The first companies being firms like IBM or big firms like General Motors or Microsoft, and these get much more weight than some smaller firms. However, all of the firms on the S&P 500 are fairly large, and sometimes we look at other benchmarks like a value-weighted portfolio of all securities that are trading in the U.S. And this takes the very smallest firms that have stock trading to the various largest firms. And then often we disaggregate the equities to look at certain portfolios of equities. For example, what I mentioned earlier, the small capitalization equities. And these are firms that, if you look at the number of shares outstanding and multiply by the market price, you find that they are fairly small compared to other firms. And this doesn't mean that these firms are penny stocks, and you should not confuse a small firm with a firm that has a small stock price. Indeed, it was the case at one point that Chrysler was a so-called penny stock, but hardly a small stock given the number of shares that it had outstanding. So it could be that the small firm has got a fairly high stock price, but just a small number of shares are outstanding. So we always look at capitalization, which is the product of the number of shares times the market price. Now it's interesting if you take a historical look, like my lecture note does, that you find that the lowest average returns are earned by Treasury bills, and the next are the U.S. Treasury bonds, and the next highest are the corporate bonds. The next highest is this overall portfolio of all equities that trade in the United States, and the next highest return and the highest return are for the smallest capitalization equities. So you can see that immediately that there's a relation between risk and expected return. So that the instrument that is perceived as the least risky, the U.S. Treasury bill, has the lowest expected return. And the equities, whether it's the value-weighted portfolio of all stocks or the portfolio of small capitalization equities, have much higher average returns than the Treasury bill. Now you should note that they have much higher returns than the corporate bonds also. That is generally true that equities are riskier than corporate bonds. And the reason, of course, is that if there is a bankruptcy for the firm, the bondholders get paid off first. And whatever is left over will go to the equity holders, and often what's left over is zero. So sometimes the equity holders are called the residual shareholders. That what they've done is that they've taken a bet that the value of the firm is going to be greater than what is owed to the bondholders. So they are clearly riskier than the bondholders in terms of what happens in a corporate bankruptcy situation. And this is exactly the way that the data lines up, so that we see the lower returns on average for the corporate bonds and the higher returns on average for the equities. So immediately, as I said, that there's a relation that we can see by viewing the historical data in terms of risk and expected return. And it turns out that this is really one of the foundational things that we say and practice in finance. That if it's riskier, you should demand a higher expected return. And really, the basis of all of this is the idea of risk aversion. So an investor who is risk averse will demand a higher return for something that's riskier than something else. So risk aversion causes the differences in the performance of these different asset classes. Now, it's rather interesting if you look at this historical behavior of asset returns, that there's a number of graphs of the investment performance of these different asset classes through time. And you can see that the Treasury bill is very stable in terms of the return that it pays, with reference to all of the other asset classes. And this is not to say that the return on the Treasury bill can't be quite volatile. For example, during the Depression, the interest rate on the Treasury bill was close to zero. It's just like a fraction over zero. And during the Fed experiment between 1979 and 1981, the 90-day Treasury bill rates were 16 or 17%. So there has been some volatility in terms of the Treasury bill. But the volatility is in terms of returns that are all positive, from 0.1% to 17%. And it's much different if you look at the equities. We've seen in the data set that I examined from 1926 a depression beginning in 1929 where there's a dramatic loss in market value. And we see other large dips in the value of the equity portfolio. The most recent dip, of course, is October 1987. It's rather interesting that looking at the graph, October 87 is definitely a dip, but in terms of the whole year, the performance on the S&P 500 at least was positive 3%.